You will watch this. Let no joyful noise be heard. Let no man look up at the sky with hope. And let this day be cursed by we who ready to wake the Kraken!
In today's episode, we'll discuss staking, a way many cryptocurrencies verify their transactions, and how the SEC is cracking down on crypto exchanges offering staking as a service to its customers. See what I did there? Welcome to GAAP Chats, the podcast dedicated to all things accounting, brought to you by GAAP Dynamics. I'm your host, Mike Walworth, and Chris is on PTO, so I'm on with my other faithful partner, Bob Laffler. We hope you'll join us on our journey today as we share our passion for accounting and help change the way you train.
Hey, Mike, that was a nice homage to the Pirates of the Caribbean. That was Davy Jones, I believe.
Yes, thank you. Couldn't resist.
And why exactly are we doing Pirates of the Caribbean?
Well, because I'm an idiot, and also because of this news story. On February 9th, Kraken, one of the largest crypto exchanges in the world, closed its staking program in a $30 million settlement with the SEC, which said the company failed to register the offer and sale of its crypto staking as a service program.
So release the Kraken! I think I get it.
Yeah, I guess you can say Kraken was released from a source of income. Bada-boom!
Not to mention an extra $30 million.
Yeah. Well, for our listeners, Chris is on vacation this week, so I'm joined today by Bob Laffler, one of the owners of GAAP Dynamics. Thanks for filling in. As our resident expert on all things investment management, I'm really, really glad you're here.
Happy to do it, Mike. I understand I have some really big shoes to fill.
Not really. Maybe only size 9. I think you'll be fine. Look at that. I'm a poet and I didn't even know it. Anyway, before we get into the SEC case against Kraken and its crackdown on staking as a service, perhaps we should provide listeners with just a bit of background on staking. What is it?
That's probably a good idea because unless you're really into this industry, you probably don't know much about what we're talking about at this point.
Yeah, so let's start it off. Bob, what is staking?
All right, so staking cryptocurrencies is basically the process that involves committing crypto assets to support a blockchain network and basically confirm transactions on that blockchain. It's available only on networks like Ethereum that operate using what's called a proof of stake protocol. Bitcoins run on a proof of work protocol to confirm their transactions.
Well, okay, so you had me at hello, but lost me a bit there. So can you explain it for those in the back? I want you to dumb it down for me.
Well, I could dumb it down for you, but Coinbase actually does a really good job explaining. They've got a web page that basically is titled "What is Staking?" And what I can do is try to summarize what they got there to maybe make it a little bit easier. And we'll put the link in the podcast notes so people can read the article themselves. But it can be as simple or as complex as you want to take it. And really what I like about the article, it starts out by keeping it really high level and basically just says that staking is a way of earning rewards while holding on to your cryptocurrencies. So essentially what you're doing is you're trying to get a little extra added benefit when you're just investing in cryptocurrencies in the first place. So the way it kind of works is, we all know that cryptocurrencies are a decentralized type of product, right? We don't have banks or credit card companies that process transactions. It's all done on the blockchain. But because it's decentralized, we need to, have some kind of consensus mechanism that takes place in order to make sure that transactions are legitimate. So that's kind of where this idea of staking and things like that comes. So I guess, there's different types, like I said, of consensus mechanisms. And I said earlier, there's kind of this idea of proof of work, and then there's proof of stake.
So are you going to talk about, let's do this. Let's talk about proof of work first, because I think that's what people think about when they think about Bitcoin, right? So Bitcoin, I think, uses proof of work. So, and this, I think, isn't this where we were talking about miners, not in West Virginia, that kind of thing, but, and these huge computer farms and BFEs sucking up all this energy. I mean, so let's do proof of work first.
Yeah, so proof of work is kind of that traditional mechanism we think of where you're basically solving these very complicated mathematical calculations and you need the big computers that are running, 24/7, generating lots of energy. And as a result, you're able to validate transactions by solving these difficult mathematical equations. So you got people around the world basically, vying to be the winner of solving this equation to be able to validate the transaction, put it on the blockchain, and of course, when they do that, they earn a little reward for their hard work, which is essentially paid in the form of additional cryptocurrency. So that's kind of the traditional way we think of it, and that's getting the solving the algorithm.
Yeah, and it wasn't too long ago, and so that, like you said, that was blockchain, and then there was like an Ethereum 1.0 that was actually using this proof of work model. And then I read that Ethereum sort of changed, and they went to this proof of stake, which supposedly was a bit more economical and environmentally friendly. So can you talk about proof of stake?
Sure, and proof of stake was necessary because that second stage of Ethereum got much more complicated, right? If you look at Bitcoin's blockchain, it's relatively simple and straightforward. If you were to try to solve the equations on some of these newer blockchains, it would actually require more energy and more effort because of the complexity of the blockchain. So proof of stake came around, which was kind of another way of getting consensus, and it ends up being faster and more efficient and certainly less costly. And basically what it is it's a way that you can get consensus through people standing by and basically providing support or backing up a particular transaction. It's essentially vouching for a transaction on the blockchain. So that's kind of the idea behind proof of stake. Now, the way that they do that is through essentially on a project by project basis. What you're going to do is you're going to get people to vote their tokens, right? You're going to get people to kind of stand up and say, I'm vouching for this transaction, with the idea being if you're willing to put your own coins at risk to validate a transaction, then that, in addition to some mathematical calculations and formulas and knowing the blockchain and having that expertise, you're able to validate the transaction. I kind of equate it to, in our legal system where you almost have the bail system, right? Where if you want to, let someone release them from jail prior to their trial, you got to put some money up, right? You got to make sure that this person's not going to cut off and run. And essentially, that's what proof of stake is. It's saying, look, I'm willing to put up the money here to say that this is a legitimate transaction. I'll put my cryptocurrencies on the line. There's a little bit of validation in that regards while we do some of the validity. And then once the transaction is proven to be true, well, then the crypto coins that were put up as a stake, the bond is basically returned to the owners. And of course, they get a nice little fee with that as well. Once again, usually in the form of cryptocurrency.
Yeah. So let me ask you a question. So, I did some research before this podcast, like Ethereum, coin, Ether coin. And actually, Ethereum's the network and Ether is the coin. But an Ether coin is currently trading, let's say, around $1,500, right? Now, help me out here. You can buy less than one coin of this stuff, right? You can buy like fractions.
Fractional ownership.
Okay, so let's say I own 20% of one Ether coin. So 20% of 1,500, what is that? It's like $300. So I own $300 of a fractional percentage, 20% of an Ether coin. How is that going to assist in this validation of this Ethereum blockchain? I mean, my ownership is too damn small. I mean, how does it work?
Well, exactly, and that's where some of these kind of cryptocurrency brokerages come into play. They individual investors might not have enough to really put up to make any difference in a staking validation. But when we gather all these different investors and they all put up their little measly shares of coins, and you put them together and aggregate them, well, then all of a sudden you have enough to do this. So what you're seeing is companies like Coinbase's, some companies like Kraken, for instance, what they were doing was they were taking all their clients' coins and saying, hey, if you want to do this, we will get you involved in staking. We'll bring them all together. we have the knowledge, we have the expertise, we have the technology to be able to do these staking validations. We'll just use your coins to be able to put them up. So as a result, the broker gets their fee, right? The cryptocurrency company certainly is going to get a piece of that action for doing staking services, and they'll pass a fee on to the individual investors who are putting up their fractional shares or whatever they're putting up.
Yeah, because I guess theoretically anyone can be a validator, but there's a lot of sort of back office stuff. You still have to have pretty good computer systems. You got to have all the legal stuff in place, and so it just isn't viable for a small bit investor like me to do it.
Of course not, because if you think about it, what you're doing is you're putting up your investment on behalf of someone else's transaction. You're going to want to make sure you're taking on some risk there, right? You're taking on the risk that this is actually a legitimate transaction. So not only are you putting up your coins, but you're going to do your own due diligence, your own work to prove that that is a viable and valid transaction. And that's where these companies come into play. They do have the expertise that can do that. They just want the backing of the coins to kind of put up as collateral.
So staking as a service. Help me with that. So basically, the like a Coinbase or Kraken, they're sort of collecting my little 20% of an Ether coin, your 2.2 Ether coins, Chris's 500 Ether coins or whatever, kind of collecting them all together and sort of putting all of those up as a stake. So what can you tell me more about staking as a service as these companies are describing it?
Yeah. So basically what they're going to do is they're going to provide the service of collecting all these different investors' coins. The idea here is you're a long-term crypto investor, right? This is not for short-term owners, because while you're putting them up as a stake, you can't sell them, right? They are basically, held and can't be used for anything else until the process is over. But the idea is if you're a long-term investor, what you're able to do is put up these coins to be used for staking. And then over time, you get a return for being able to do that. So not only are you continuing to invest in cryptocurrency, but now you're getting this added benefit of a return, which in some cases could be 25, 35% return from these staking services.
So you looked it up a little bit. How does Coinbase describe it? I think we have that. So because it seems all so rosy when these guys are describing it. So why don't you read what sort of Coinbase? I know you did some research here.
Well, here's how Coinbase describes it. But for a vast majority of participants, there's a simpler way to participate. Via an exchange like Coinbase, you can contribute any amount you wish without needing to purchase or operate expensive validator hardware. Staking is available to most Coinbase customers in the US and many other countries.
Well, I can tell you, Bob, it won't be available to US customers much longer. More on that in a moment. Bob, I seem to recall, I think, Bob, as I mentioned, he's our resident IM, investment management guru. And Bob, every year, Bob puts together our annual IM update in both US GAAP and IFRS. Shameless plug here. If you want the IM update in either US GAAP or IFRS, it is on the Revolution, our online learning platform. I'll put a link to these courses in the notes to the podcast. But Bob, in this last year's e-learning course, IM update, I seem to recall a case study dealing with staking and staking as a service. Can you maybe provide us a bit of a summary of that case?
PCAOB inspections and the associated inspection reports can bring stress to audit engagement teams everywhere. If you want to improve your team's audit quality and reduce the number of potential deficiencies in your reports, GAAP Dynamics can help. Join us for our upcoming webinar, Improving Audit Quality, on Tuesday, April 25th, 2023 at 11 a.m. Eastern Time. It's free to register, and you'll hear directly from PCAOB inspectors about risk assessment, internal controls, supervision, and review. And the best part, you can receive up to 1.5 hours of CPE credit. Register now at gapdynamics.com. That's GAP with 2 A's, dynamics.com, or simply click the link in the description. Hope to see you there.
Yeah, sure. I mean, first of all, when it comes to cryptocurrencies, the one thing we've seen over the past several years is investment companies, funds are kind of the leaders, right? These are the ones that are most commonly investing in cryptocurrencies. Obviously, we're starting to see other operating companies do it as well, financial services companies and so forth. But really, there's a lot of funds that have said, "Hey, I'm willing to put a percentage of my portfolio into cryptocurrency." So we've seen a lot of issues related to cryptocurrency in the funds industry. And one of the more recent examples we had was dealing with investment funds that are using their cryptocurrency for staking, right? They're putting their currency up. They're long-term investors and they're putting up the staking. And really the issue that was addressed was when you are receiving income from staking services, does this impact your qualification as an investment company under ASC 946?
Yeah, so just to kind of back up for those that don't know, I mean, if you are deemed an investment company under ASC 946, then that means you have special accounting, right? Things like all your investments are at fair value through the P&L, no consolidation, special reporting, et cetera, et cetera. So if this special accounting, how does the staking impact, how could this staking impact that qualification as an investment company?
Well, that's where the heart of the issue is, Mike. So basically, in order to be an investment company, have all these special requirements, everything at fair value consolidation, like you said, you need to essentially be a passive investor, right? You essentially are holding your investments for the purpose of capital appreciation, investment income, or both. That's essentially all you're doing, right? You're taking people's money, you're providing professional management services, and you're putting it to work, and you're just sitting back and watching the returns come in. When you start getting involved in other activities where you're actively kind of doing other things to generate income, it could call into question whether or not you're really acting more like an operating company and no longer a fund who's just involved in passive investing. And this idea where you're getting involved in staking and earning fees from these extra activities, that's where it starts to create a little bit of a gray area with qualification as an investment company.
Yeah, so this class discussion, usually our class discussions, we sort of tee it up and then we sort of ask the class kind of what they think. So what was the answer? What was the final conclusion in your case study?
Well, the final conclusion, like so many of our class discussions, is it depends.
Why do people hire us? Why do people hire us then? No, I mean, I'm sure we talked about it. So what is going on here?
Well, it's in the nuance of the situation. First of all, the issue was discussed by the AICP expert panel for investment companies. They're an active group that basically involves some of the leaders in accounting and actual audit that are involved in this industry, and they deal with these questions quite a bit. And their discussion on this topic was, not surprisingly, yeah, we've got a bit of an issue here. You're doing things that are not in the normal range of investment companies. However, we've seen other activities in the past that do this as well. And namely, what they mentioned was security lending activities, right? It's not uncommon for a fund to have long-term investments in securities and basically say, well, while I'm holding these investments for a long period of time, why don't I get involved in lending out my securities? If there's another investor out there that wants to sell a security short or something like that, sure, borrow my securities. It allows them to get a little extra return from their investments. The issue, of course, here was that, securities lending, there's usually a relatively small margin, a small fee that you're earning from that particular activity. As I mentioned earlier, when it comes to staking, there's a lot of risk involved in staking, and therefore the return, the fee is a bit higher than what we're used to seeing. And that was really where the expert panel came in. They said, look, from our understanding, some of these staking fees can be quite significant. And therefore, the extent at which you're involved in that activity really can generate a substantial source of income that could throw you out of this definition of an investment company.
So basically, and this is kind of when this issue, is it an investment company? Is it not an investment company? ASC 946 has these fundamental characteristics and then these typical characteristics. All the fundamental characteristics need to be met. If you bomb out on one of them, you're out. But at the end of the day, it probably is judgment, right? And like you said, for these other types of quote unquote operating activities, if it's kind of just a little bit here and there, I think what the experts panel is saying, right, is that's probably okay. you're probably still an investment company. But if it's significant and you earn significant fees and it's a significant portion of your operation, then you're more like an operating company. So really, I mean, I guess the AICPA expert panel, they punted, but they don't really have all the facts. They're sort of just talking, and that's what we do in our class discussions too, just sort of talk about it. But at the end of the day, it's auditor judgment and management judgment, right?
Absolutely. I mean, every case is going to be different, and it really comes down to how significant is that particular fund. So, they had other issues they brought over the years, where you do lending and you get origination fees. When you do mining of cryptocurrency, we talked that one a few years ago, and how the extent of mining could potentially throw off this definition. So,
when actually you think about the mining. Well, that's interesting, Bob. I was this many days old when I realized that class discussion 2 years ago or 3 years ago dealing with mining, that was just the proof of work validation. This is now staking. It's the proof of whatever. What are we calling it? Proof of what? Proof of stake.
Stake.
Yeah, that's a whole topic of the podcast. Yeah. So I guess my point is all of this stuff could call into question. And it is interesting. One of the things you mentioned is the AICPA expert panel kind of likened it to securities lending, because actually that is essentially what the SEC is alleging in their charges against Kraken. And so in their press release on February 9th, here's what the SEC said. The Securities and Exchange Commission today charged Payward Ventures and Payward Trading, both commonly known as Kraken, with failing to register the offer and sale of their crypto asset staking as a service program, whereby investors transfer crypto assets to Kraken for staking in exchange for advertised annual investment returns as much as 21%. So there you had said 25, 35. Yeah, that's a big return. It seems too good to be true.
Good.
Yeah. To settle the SEC charges, the two Kraken entities agreed to immediately cease offering or selling securities through crypto asset staking services or staking programs, and pay a $30 million fine or disgorgement, prejudgment interest, and civil penalties. SEC Chair Gary Gensler said, whether it's through staking as a service, lending, or other means, crypto intermediaries, when offering investment contracts in exchange for investors' tokens, need to provide the proper disclosures and safeguards required by our securities laws. Today's action should make clear to the marketplace that staking as a service providers must register and provide full, fair, and truthful disclosure and investor protection.
So the SEC is basically saying that these contracts are securities and therefore they should be registered with the SEC, and they must follow basically all SEC rules and regulations.
Yeah, you got it. I think the SEC doesn't want to see another FTX, and therefore they've decided to rein in the industry come hell or high water. In the same press release, Gerber Grewal, I probably screwed up his name, but he's the director of the SEC's Division of Enforcement. Here's what he said. In case after case, we've seen the consequences when individuals and businesses tout and offer crypto investments outside of the protections provided by the federal securities laws. Investors lack the disclosure they deserve and are harmed when they don't receive them. Today, we take another step in protecting retail investors by shutting down this unregistered crypto staking program through which Kraken not only offered its investors outsized returns, untethered to any economic realities, but also retained the right to pay them no returns at all. All the while, it provided them with zero insight into, among other things, its financial condition and whether it even had the means of paying the marketed returns in the first place.
That's pretty damning. Kraken can't be the only company doing this, though, right? I mean, there's plenty of people that have been involved in staking.
Well, you're absolutely right, Bob. They are all doing it. A Wall Street Journal article from last week stated that Coinbase, so Kraken is the number 3 kind of crypto exchange. Coinbase is number 2. So in this Wall Street Journal article, it says Coinbase helps users put their crypto up for staking, with a network taking a commission from between 25 and 35% on any interest that the users might earn. That revenue stream is particularly important for the exchanges when crypto prices and trading volume are falling.
Too bad, because it looks like the SEC is putting the old kibosh on staking as a service for these companies, huh?
Well, maybe, but first of all, only in the U.S. The SEC's tentacles don't stretch kind of beyond our borders unless, of course, the entity is listed in the U.S. And by the way, Coinbase is. Coinbase is listed as a NASDAQ company. But they're not going down without a fight. Coinbase CEO Brian Armstrong has pledged to fight if the SEC goes after Coinbase staking, while the largest crypto exchange in the world, Binance, has said it is monitoring the situation.
I think when dealing with the SEC, the more measured approach taken by Binance is probably the right call.
Agreed, but let me tell you, this crypto bro Brian has some balls. Okay, he I guess having what is he? I looked him up. He's on the Forbes. I think he's like 380 something on the Forbes richest people, and worth about $2.4 billion. So that kind of gives you some cojones, I guess. But anyway, he said, and I quote, "Our staking product is not a security. Customers never turn their assets to Coinbase, for instance. And we really are just providing a service that passes through coins to help them participate in staking, which is a decentralized protocol." Armstrong has disagreed with Chairman Gensler in the past, and according to a recent Bloomberg article, the company said recently that it may not remove a particular crypto asset, even if the SEC alleges that it is a security, and basically they want to take it to the courts.
Well, I wonder how it's going to work out for them.
Well, that Bloomberg article also said that Coinbase has received investigative subpoenas from the SEC about not only staking, but also stablecoin and its yield-generating products. And Coinbase posted a $557 million loss last quarter and saw its revenue tumble 75%, as obviously trading volumes plunged amid a series of prominent industry bankruptcies and scandals. Its shares traded at more than $400 when the company was first listed on the NASDAQ in April 2021, but today the stock is just north of $60 per share.
Wow, nice move, crypto bro. Picking a fight with the SEC, that's probably not the way to go, or though maybe in his view, it's kind of like what Charlie Sheen calls winning.
Yeah.
Maybe he won't be on the Forbes list for too much longer, huh?
Yeah, I don't know. So we'll have to see. We'll pick it up in a new podcast. But Bob, I want to thank you for joining me today. Hopefully you'll be back. Did you enjoy it?
It was my pleasure. Yes, easy. Happy to do it.
Awesome.
But I don't want to take all the fun away from Chris, so I'm sure he'll be excited to be back again soon.
Well, I'm actually going on holiday next week. I'm taking my daughter out your way, California, for her spring break. She's in college. And so you got another week of it.
I get to be Davy Jones next week and get to do the acting. Fantastic.
Well, I don't know that we're going to talk about Kraken next week, so you're going to have to find some
I'll
other
come
act.
up with something new, though. All right.
Awesome.
Well, or
awesome.
we can get Chris to act.
There you go. All right, I'll take us out. That's all for this episode of GAAP Chats, your source for all things accounting. Notes and resources from today's episode are linked in the description. And as always, you can find us online at gapdynamics.com and at Gap Dynamics across social media. It's never too late to become a Gapologist. Head over to our website and subscribe to our blog so that you're the first to know what's new with Gap Dynamics.